Okay, so today's lesson is on bank reconciliation statements. Bank reconciliation statements look like this. So the title at the top, bank reconciliation statement as at, and the date of the statement. And then there are 4 lines to it. So you start off with the balance as per your cash book. So whatever your closing balance is on your cash book, you add back something called unpresented checks. You take away something called bank lodgements or outstanding lodgements, and that will equal the balance as per the bank statement. So it's a relatively straightforward financial statement or bookkeeping entry to learn. However, you must make sure that you get your unpresented checks and your lodgements the right way round. So remember to add the unpresented checks, take away the bank lodgements. Okay, if you get that, the rest of it should be straightforward. Obviously, you don't know what those are yet, but I'm going to teach you now. So, bank reconciliation statements, they are a bookkeeping tool. So not quite a financial statement, but something that we produce to ensure the cash book is kept up to date and to ensure that any discrepancies between the bookkeeping entries and the bank statement are identified. So essentially, what that means is there is very, very likely going to be a difference between what you think you have in the bank as per your cash book and what the bank statement shows. So it's very, very likely that there's a difference between the two. So we create a bank reconciliation statement to make sure that we understand why there is a difference. Because remember, in accounting, we're all about accuracy. We must make sure that everything is accurate, is up to date, and if there are anything that we're unsure about, that we have recorded what we're unsure about, why we're unsure about it, and what we're going to do to fix it. So the bank reconciliation statement is going to help us with that. Now, there are 2 very important things for you to remember. The first thing I want you to remember is the bank statement is a source document. So it's a place where we get information to enter into our accounts. Just like an invoice, just like a credit note, just like a receipt. The bank statement provides us with information. There are a lot of transactions that go through the bank that you won't receive any other form of source document for. For example, direct debits, for example, internet banking payments. The only place that you'll ever see those is on the bank statement. So we use the bank statement as proof that that transaction has happened, and then we can enter it into our cash book. The other thing that you need to know is that there is a time difference between your entries and the bank's recognition of the transaction. Now, all that means simply is that when you record information into your cash book and when the bank records it on the bank statement, there can be a big gap between the two. Just to give you a quick example, if you were to write a check today, you would have that check, you would have the counterfoil or the check stub as well. So as soon as you've written the check, you'll fill out the counterfoil, and then you've got a source document to enter into your cash book. However, the check itself still hasn't come out of the bank. You may need to send that check in the post to your supplier, and then your supplier will have to take it to the bank, and then the bank will have to process that transaction. So if you write it today on a Monday, you send it to your supplier, they'll get it on, say, Wednesday, they'll take it to the bank on Thursday. The bank themselves may not process that transaction until Wednesday, Thursday of the following week. So we'll have taken the money out of our bank on the Monday, and yet it won't come out of the bank and appear on the bank statement for another week and a half. So there's going to be a big difference between what we think we've got in the bank and what the bank statement shows we've got in the bank. Okay? So those 2 important points to remember, that the bank statement is a source document, and there is a difference in time between when we record the transaction and when the bank records the transaction. So basic concept of the bank rec is simple. Ensure you understand why the cash book and the balance on the bank statement is different. Okay, that's all it is. We're just trying to understand why our closing balance on our cash book and our closing balance on our bank statement may be different. So in order to do that, we go through 7 steps, and I'm going to take you through those 7 steps momentarily, but that slide there is your guide on how to complete a question. So let's go and just check some key terms first of all. So the first key term is unpresented checks. Okay, these are checks we've made and sent to our suppliers, but yet to be taken from our bank. So going back to the example I used earlier, we wrote the check on a Monday, it didn't come out until a week and a half later. That would be an unpresented check. It's a check that we think has come out of our cash book, but is yet to be taken on the bank statement. So it will be on the credit side of our cash book, and it'll be unticked. You might not know what unticked means yet, but you will in a minute. Outstanding lodgements are very similar, but this time they appear on the debit side of our cash book. They are amounts that we think have gone into our bank, or we've got a source document to state is going into our bank, and therefore has increased the balance on our bank account. However, the bank has yet to receive that money, so they are not showing that increase to our balance on the bank statement. So again, they appear on the debit side of the cash book. A couple more terms: dishonored check, which we've seen before when we've done control accounts. So these are checks that have been entered into the books, but when presented to the bank, the payee does not have enough money to pay the check. So a dishonored check, there's kind of 2 entries to a dishonored check. The first entry is to debit your bank with the money you think you received when you get the source document. A few days later, the bank will either ring you, or you'll see it on your bank statement that that check didn't actually go through. Okay, so as you've originally debited your bank statement, your bank account, sorry, with the amount of money received, you don't actually have that money, so you need to credit again. Credit transfers are what you probably think of as internet banking payments. They're amounts paid into and out of an account directly through the banking system. More common than checks these days. People don't really write checks. Everything's done via mobile banking apps these days. So credit transfers, very, very popular. Think of them as internet banking payments. A couple more. Standing orders. Standing orders we've talked about previously when we've done the cash book. They are amounts paid from one bank to another on a regular basis, usually monthly. Standing orders are different to direct debits in that you cannot change the amount of the money to be received if you are the receiver. Okay, so I might set up a standing order to you for £10 per month every single month to pay you for a service, and you cannot change that amount, but it will come out of my bank every single month on a specified date. Direct debits are very, very similar, as we've just said. They are regular transactions that come in or out of a bank, but the person receiving the money has the ability to request that the amount taken each month is changed. So, for example, there we've used the mobile phone one. Your mobile phone amount differs every month. So O2 might take £30 one month, they might take £35 the next month, and so on and so forth. So direct debits are very similar to standing orders in that they're regular transactions, but one will allow the receiver to change the amount every single month. A contra entry is when we've got a transaction that affects 2 accounts within the books for the same amount and has 0 effect on the value of the business. All right, so in this example, it's when money is taken out of the bank and therefore becomes cash, or when cash is placed into the bank. So in my class, we say that contra means call it quits. So it has 0 effect on the value of the company. So the bank statement, remember it's created by the bank. All right. The bank statement is created by the bank. So before we go any further, this is something that you need to know. It causes confusion every single year. So from the bank's point of view, the debits and credits are going to be the opposite way around. So where we would debit our cash book to see money going in, on the bank statement, that will appear as a credit. And money going out in the bank statement will appear as a debit. And there's a really simple reason for that. And that is that the bank statement is produced from the bank's point of view. And to the bank, a customer is a creditor, strangely enough. So even though you're a customer of the bank, you are also a creditor to the bank. Because every time you put money into the bank then owes you that money. All right, that's the basics of it. So when you look at a bank statement, if you see something on the credit side of your bank statement, that means the money's going up. If you see something on the debit side of a bank statement, that means the money is going down. So it's different to our normal way of thinking in accounting, but one that we should easily be able to get around. So there is an example there of a bank statement. You can see the balance at the top is 430 credit. Now that means that there's £430 in that account, and it is a positive amount. When we pay out the check to F Banks for 250, we can see that the balance goes down to 180, even though that 250 is on the debit. So remember that the bank statement is from the bank's point of view. All right, so there you can see we've got a bank statement of 430, and at the very bottom of our bank statement, we've got a balance of 260 on the credit. Now the cash book for that, this is for the exact same company, starts off at 430, as you can see there, so that's good. And then we've got similar transactions, but let's just choose one example. So we have the check to F Banks on the debit at 250. In our cash book, it'll appear on the credit. Okay, so remember the bank statement is from the bank's point of view. So debits reduce a bank statement, credits increase a bank statement. Okay, so what we're going to do now is we're going to do a bank reconciliation statement for this company. You can see the bank statement has got several transactions on it. Just to be clear, the balance there is a rolling balance. We're looking at the top balance and the bottom balance, 430 and the 260. But you can see there's lots and lots of transactions, 1, 2, 3, 4, 5, 6, 7, 8 transactions on there. Oops. And on our cash book, we've got 1, 2, 3, 4, 5, 6, 7. We've got 7 transactions on our cash book. So we're going to end up with a different balance. So we need to understand why there is a difference between our bank statement and our cash book. You can see there's transactions on there that don't appear on both. So the first thing that we're going to do is we're going to tick off items that appear on both the cash book and the bank statement. All right. Now, what I don't want you to worry about when you do this is the date. Remember, there are timing differences. All you are looking for is the value of the transaction. Okay, so the value of the transaction is what is important there. Okay, so we can see that F Banks, the 250, is ticked off on the bank statement, and it's also ticked off on our cash book. All right, and we do that for every single transaction that appears on both. If it appears on both, we can tick it off and we can say we are accurate. And so as you can see, there are items on the bank statement that aren't ticked off, and there are items that are ticked off. Ticked off ones we're happy with. Ticked off ones, sorry, the ones not ticked off, we need a bit more info on. So again, the cash book, we tick off those items that appear in the cash book and on the bank statement. All right, so it appears on both, tick both entries off. And again, the cash book has got some items that are unticked. All right, so we need to make an adjustment for those. So first things first, tick off items that appear on the bank statement and on the cash book. Next step is to update our cash book. All right, remember the bank statement is a source document. All right, so let's just go back to our bank statement. And we had the amount of 200 to British Gas. We received 240 from J Ball. We also had £20 bank charges and a dishonoured cheque of 150. All of those items on the bank statement were unticked. Now, as the bank statement is a source document, we're going to add them to the cash book. So anything that is unticked on your bank statement needs entering onto the cash book. And remember, if it's a debit on the cash book, it's going to be a credit on the bank statement. If it's a credit on the cash book, it will be a debit on the bank statement. So let's just use some examples there. We've got J-Ball at 240 was unticked on our bank statement on the credit, so we ended up putting it onto the debit of our cash book. So once we've ticked everything off that appears on both, we're going to enter anything that's unticked on our bank statement into the cash book. Okay, once they've entered into the cash book from the bank statements, we know that they appear on both, so we're going to tick those off as well. And then we're going to balance off our cash book. All right. So step one, tick items that appear on the bank statement and on the cash book. Step two, enter anything into the cash book that is unticked on the bank statement and then tick them off to show that they appear on both. Step three, balance off your cash book. All right, so with these updated items, we've now got a balance brought down of 580. Now, if we go back to our bank statement again, let's just very quickly do that. Remember that the balance on our bank statement is 260. Yet when we've updated the cash book with that extra information, we've got a balance of 580. However, we've still got these unticked items. These are items that appear in our cash book that don't appear on the bank statement. And this is where the bank reconciliation statement will come in. So we've got 560 on the debit and we've got 140 and 100, so 240 on the credit. Oops. So balance as per the cash book is £580. We're going to add back those unpresented checks of 240. All right, so the unpresented checks are on the credit side of our cash book and they remain unticked. So we have sent these checks, but they have yet to be processed by the bank. On the debit side of our cash book, we have that 560 unticked. That's an outstanding lodgement, and we're going to take that away. So 580 plus 240 minus 560 gives us the balance as per the bank statement of 260. So now we understand why there was a difference between our cash book and our bank statement. Okay, it's because of these transactions here that we have recorded but have yet to be recorded by the bank. So we can keep an eye on that and make sure that eventually they will be recorded by the bank. And if they're not, we can chase that up and say, we put 560 quid into our account recently. Why have you not done that yet? And they'll say, whatever reason. Okay. So that is a bank reconciliation statement, and that is how they are done. So very quickly, one more time, start off with a bank statement and a cash book. If it appears on the cash book and the bank statement, you can tick them off on both. If it doesn't appear on both, leave it unticked. Anything that's unticked on your bank statement, add to your cash book. If it's a debit on the bank statement, it's a credit to the cash book. If it's a credit on the bank statement, it's a debit to your cash book. Once you've updated the bank statement with those additional items, balance off your cash book. Cash book, you'll have unticked items still remaining. Anything on the credit side that is unticked is an unpresented check. Add those up and add it to your balance as per the cash book. So they take away from the cash book, so they add to the bank reconciliation statement to adjust for the timing difference. Anything on the debit side that's unticked has increased your cash book, so it's going to reduce your bank reconciliation statement. And then that should, if you've done everything right, give you the same balance as appears on the bank statement. Be careful when balancing off your cash book though. If you brought down balances on the credit side, make sure you recognize this in your bank rec by putting it in brackets. Really common thing for the examiner to do is once you've balanced off your cash book to give you a brought down balance on the credit. People then transfer that to the bank reconciliation statement, but forget that it's a minus figure. So if you do that, then your bank reconciliation statement will never balance. So just make sure that if it's on the credit side, you put it in brackets and recognize that it's a minus figure. Another thing is unpresented checks and outstanding lodgements may appear on more than one bank rec due to timing differences. For example, I've still got a check in a drawer from November that I was sent that I have yet to put into the bank. It's for like a £5, so I've not bothered going to the bank. But for that company, that is going to appear on their bank reconciliation statement up to the point where I actually enter it into my bank, okay, where I go to the bank and put it in. So just be careful with that. We'll go through some examples of that later this week. But in an exam question, what that will mean is you'll get a list of unpresented checks from the previous month. Okay. If you then see them on this month's bank statement, you can tick them off. If they are unticked, then they need adding to this month's bank reconciliation statement as well. The biggest way to find out if there are unpresented checks or outstanding lodgements from the previous month is to check your opening balances. If your opening balance on the cash book and your opening balance on the bank statement are different, check the additional information for items from the previous months. So what do we do if the bank is wrong? Obviously, sometimes we make errors. If we make an error, we'll notice it on the bank statement and we can update our cash book. But sometimes the banks make errors too. So in order to do that, we might produce a bank reconciliation statement and make a simple adjustment to the bottom of it. Okay, so it's exactly the same steps that we've just been through, but we're going to make a couple of extra steps at the end. And you can see they've got those 7 steps again, but we've got 2 extras at the bottom. So we'll have a little look. So here's my example. I've started ticking this off already. I've got a cash book. I've started ticking off the 2 items that appear on the bank statement. You can see those appear there. However, within my additional information, it says that check 100644 was paid to Hassan and is incorrectly input by the bank. Now, on our cash book, the amount for Hassan was 285. However, that check can be seen on the debit side of the bank statement at 292. So they made a little error when entering it into their system. All right. Now we know we're correct. So we contact the bank and let them know. However, when we do our bank rec, we're not going to be able to balance because the difference between that 285 and that 292 will still exist. So remember, we started ticking things off already. If it appears on the cash book and on the bank statement, then we can tick them off. So that 355 and the 282 appear on both, so I've ticked them off. Okay, we've still got unticked items on our bank statement now. You can see that the 35 and the 42, and plus we've still not made the adjustment for that 292. So here's what I'm going to do. I'm going to tick off those items. Where is it gone? I'm still not going to tick Hassan off until the bank makes the adjustment, but I am going to add that 42 and the 35 from the bank statement. Okay, remembering that the bank statement is a source document. So if I get information of money going out of my account, such as direct debits or charges, then I will need to add them to my cash book. So I've got the original two items, the 282 and the 355 ticked off. And then I've got the two extra additional items from the bank statement as well. I've then balanced off my account, and my account is equal to 1,658. Okay, but I've still got unticked items on the debit side of my cash book and on the credit side of my cash book. So a balance as per the cash book is 1658. I'm going to add the 443 that was on the credit side of my cash book that remained unticked. And I'm going to take away those outstanding lodgements of 650 and 865 that appeared on the debit side. So 1658 plus 443 minus 1515 gives me 586. I'm then going to make an adjustment for the bank's error. Remember, they put £7 too much for Hassan. So I'm going to take that £7 away, and I will get my adjusted balance as per the bank statement of 579. Okay, and let's just check that that balances with our bank statement. It does indeed. You can see at the bottom of our bank statement, we've got 579 as a total. Okay. So we balanced it off, making the adjustment for the £7 difference between the 285 and the 292 for Hassan. So again, the process was exactly the same. We ticked items off. Items that were unticked on the bank statement got added to our cash book. We balanced off our cash book, and those unticked items that still don't appear on the bank statement, we make our bank reconciliation statement with. So the balance as per the cash book, add the items on the credit side that are unticked, take away the items on the debit side that are unticked, and that should give us our balance as per the bank statement. But in this example, we've got that error of £7 that the bank made. So we'll take that away, and then we'll understand exactly why there's a difference between our cash book and our bank statement. So the reasons for bank reconciliation statements. Now, this is taken directly from a mark scheme, so it might be worth you learning it. So first thing, it enables those missing entries in the cash book to be accounted for. So anything that's on the bank statement that we don't previously have in our cash book, we can update. All right, and that'll prevent any errors in the financial statements. There will be no errors of omission if we use the bank statement to update our cash book. Also, any errors that we might have made ourselves, any numerical errors, we can check against the bank statement. Bearing in mind that the bank statement is sort of an independent check on what we're doing. All right, and if there's a difference between the two, we can ring them and they can ring us, and we can find out why there are any differences. So it enables those errors, enables errors on the bank statement to be corrected, as we've just seen with the Hassan check, and we can notify the bank for correction. Also enables out-of-date checks to be identified and cancelled in the cash book. Now, when you write a check, you have 6 months to cash it. So that check that I've got from November, I went November, December, January, February, March, April. I've got until the end of April to cash it. Otherwise, that check becomes invalid. All right, so if you send someone a check and they don't put it in their bank, They only have 6 months to do so, and if not, it gets cancelled in the cash book. All right, so we'd originally have credited our cash book, and it'd have been a unpresented check up until the point of 6 months when we realised that they're never going to cash it. So we will take it out of our cash book again by putting it back on the debit. Also, it acts as a deterrent to fraud. Now, I know you're all obsessed with fraud, but by making sure that we're checking what goes in our cash book against what goes in our bank statement, we can recognise any transactions that aren't familiar to us. All right, so if there's an amount going out on the bank statement that we haven't got in our bank statement, sorry, there's an amount going out of our bank statement that's not appearing in our cash book, apologies, then we can investigate why. All right. So if you see £100 going out of your bank on the bank statement and you don't know why, you can ring the bank and find out if someone is stealing from you. Okay, so those are the reasons for the bank reconciliation statement. But most importantly, it's there so we understand why there's differences between the two. And remember, it's all about accuracy. It's about making sure we understand why items appear on the bank statement or why there's a difference between what we think we've got as our bank balance and what the bank think we've got as the bank balance. Okay, it's very important, and it's all about that accuracy. And that's it. So we'll go through some questions with you, and anything you need help with, give us a shout.